Hello everyone and welcome back to the channel. In this video, I would like to explain to all of you the out of the money and the in the money covered calls. And I'm going to show you guys here some few numbers here so you guys can have an idea what I'm talking about, especially the realized of return and annualized rate of return. Okay, and of course, we're going to do here on purchase price and also on buying power so you guys can have an idea which one let's say worth more for us to trade or not. Okay, both of them has the pros and cons, but when you're talking about here, let's say the out of the money the covered call is very simple. What we're gonna do is to trade the out of the money covered calls, we're gonna purchase the share, okay, at the current stock price, in this case 222, which it is the IWM, which tracks the performance of the ROR 2000, and we are going to put here, okay, a call option above the current stock price. This is how we set up the out of the money covered call. For us to set up in the money covered call, the same thing as well. We're going to still buy the shares here at the current stock price, and we are putting our call option here, okay, below the current stock price. So in this case here, we're gonna put, let's say, actually I have on my spreadsheet, we're gonna sell here the strike price of $231, and here we're gonna sell the strike price of $202.50. Okay, so here we're gonna have intrinsic value plus extrinsic value, and of course here we're gonna have only extrinsic value. Why? Because options they are trading and at the expiration date out of the money only have extrinsic value. Of course, once it expired, doesn't have nothing anymore, neither EV nor IV. But once it's trading out of the money, it's only extrinsic value left. But this one here, because the strike price is going to be below the current stock price, is going to have both intrinsic value and extrinsic value. And of course, you can break down this thing here into volatility, days to expiration, and so on. But let's stick just with the implied volatility and intrinsic value and extrinsic value. So the first one you're gonna do is the covered call with the call option above the current stock price. If you come here to my TastyWorks, we're gonna hold here in about 32 days to expiration, and we're gonna sell here the $231. Okay, and of course at the same time we're going to buy the shares. So basically what we're gonna do is we're gonna press here sell covered call. We're gonna move our strike price all the way up here. Now this way is up, so we're going to pay here $218.46. Okay, remember this number, because what we're gonna do now is we're gonna go back here to our PowerPoint and we're gonna put here this price here that we just pay. Actually, let me go back here. So okay, here we go. We just paid this price here to open that contract, $218.46. And IWM, it is trading right now at 221.67 at mid price. So we're gonna use both of these numbers here. The strike price, it is $231. Today is 22nd of October. Okay, and our expiration date is gonna be on 22nd of November. In other words, 31 days to expiration, and that option, that covered call, it is out of the money. Okay, and the buying power to open that trade is 10,764. If I go back here, I can show you guys. So like I said to you, this is our price that we paid to open the trade. This is our buying power required. These are our strike price. These are days to expiration. The mid price here, like I said to you guys, is 221.67 cents. We're gonna sell one covered call. All right, so very, very simple. So in this case, as you guys can see, our maximum P&L is going to be 1,254 with the maximum loss of 21,846. And if you go back here to our trading journal, this is exactly like I said to you guys, our maximum P&L is going to be 1,254, like I showed you on TastyWorks. And of course, our maximum loss is going to be 21,846. If we calculate here our break-even, our break-even is $218. Very simple, guys. Strike price minus premium. Our break-even in terms of dollars, we are $9.33. Okay, below the current stock price right now, which is 221.67 cents, and give us a 4.2% cushion to the downside. If we calculate here now our rate of return in terms of buying power, because we only require to put 10,000, as you guys can see, and not the whole maximum loss of 21, of course, we're going to have a way higher rate of return in terms of annualized than if you were to purchase the share. Let's treat this that if you're going to purchase the share at this price here, which it is our maximum loss. So our rate of return is going to be 5.66 and annualized 66.6. Why? Because you're going to be on the trade for 31 days. I'm talking about here, taking this thing here to expiration date, okay? So basically, the buying power, for those of you that have a cash account, things like that, small account, forget about that. I trade on portfolio margin, so we can get way more for our bucks, but for our dollar. But as you guys can see, that's not too shabby. 5.66 return in 31 days, which is an amazing return, and 66.6 annualized. So now, if we go back to our TastyWorks, we're gonna move this strike price to be in the money, okay? To be in the money, you're gonna move all the way down here to $202 strike price. Our maximum loss now is 19,986. Our max PNL 264. We're still selling here one contract, okay? Very simple. So now back to our spreadsheet. So this time here, we are going to trade our option that is in the money. Why? Why it's in the money? Because here is the stock price, in this case IWM, and our call option, it is below the current stock price. So this is in the money before we put up here, which was out of the money, okay? So basically now it is in the money. The stock price again 221.67, strike price 202.50 cents. And that's how much you're gonna have to pay to open this trade, 199.86. And our maximum PNL is gonna be $264. But as you guys can see now we have intrinsic value and extrinsic value. Before, we only had extrinsic value, which was the full price of the call option. Now we had both intrinsic and extrinsic value. Why? Because this thing here, it is in the money. But look at this. Our break even in terms of dollars now, it's 19.17 and not only $9. And in terms of downside protection, we get 8.65. But of course, there's a payoff. The payoff is simple, guys. This, your return, okay? That's the cost. There's no free lunch. So in this case here, we're only gonna get 1.19% rate of return with the annualized of roughly 14.5. This is amazing. Okay, this is not too shabby because my goal is to get between 12 to 15% per year annualized. That's not too bad. If you get let's call this thing here 1.2. If you get 1.2% per month, that's an amazing return. This is only for 30 days. If you can finish the year with 12%, guys, it's an amazing return. But 12% of 1K portfolio is $120. Okay, forget about the dollar value. Concentrate on the rate of return. Because 1.2%, okay, out of a 10 million portfolio, it's $1.2 million. You guys get the point. You guys get the gist, okay? So the main goal here, it's not the dollar return, it's the percentage return. Because if you cannot get let's say for example, 1% trading a 1,000 account, you're never gonna get 1% trading $1 million account. That's never gonna happen. That ain't gonna happen. Because the strategy, the procedure, the technique, the patience, the discipline is still the same. The only thing here that changed is K from M. Nothing else. Okay, and even the return is still the same. We're gonna still get here 1% per month on this thing here. Is what $10,000. Okay, $10,000, 10% per year is 100K. It's an amazing. If you can get 10% per year. This case is 14.5, but if you call this thing 10% per year on $1 million portfolio, you're pulling out of the market 100K per year. It's a lot of money. Okay, especially trading options. But this is mainly, guys, the difference between trading in the money and out of the money covered call. The main thing here, of course, in the money, you're gonna have way more downside protection, but of course, you're gonna have way less return. Out of the money, you're gonna have way more return, less protection, but way more return. Because of course, you also getting, let's say for example here, Okay, let's say for example it's trading at like we saw before, 221. Okay, your strike price here is 231 plus your call option that you receive, let's say $3. Okay, remember we have this gap here to make money on the shares. Okay, from 221 to 231, you already have $10 per share. Here alone, you have $1,000 just in capital gains from the shares, plus the call option that you sold. But in this case here, okay, in this case, there's not capital gains in the shares, and the extrinsic value here, it's very small, because that's what you get here at the end, the extrinsic value. So you guys get what I mean. That's why here we have like 1,254. Here we have 264. Why? Because this has no share gains, and here of course we got the shares, let's say appreciation at the end of the option expiration date. Okay, so here we're gonna get way more money out of the money, because we can have the share gain in terms of price appreciation up to our call option that we sold. All this gap here is going to be share appreciation, but down here there's no appreciation on the stocks. We're only going to add here, guys, whatever we're going to have at the end, which it is the premium, okay, that we sold, which it is the extrinsic value out of the option. Okay, simple. In this case here, as you guys can see, the $2.64, because the 19.17 is just intrinsic value, and at the expiration date we don't get this, we only get this thing here. So this is mainly the difference between trade in the money and out of the money covered call. Very simple, but what I suggest you guys is to have something like this, because it's very important. As you guys can see, this is just a bit of what I do in terms of my trading journey. I got plenty of other things as well, guys, that I trade, but this is just few things that you need to pretty much quantify to calculate if your things worth at the end. As you guys can see here, this is rate of return, rate of return annualized. This is the final. At the end, how much you got here in comparison to what you have here. So you can have an idea if it's worth or not close the trade, okay? Here we can have the X dates, how much you bought to close, net P&L, final days in the trade, and then you can get the calculation here at the end. By the way, I hope you guys get the point. Very simple explanation. These are the main things that you need to take in consideration, because trading the money and out of the money covered call is two ball games. Okay, and if you go here, for example, let me go back to trading view. Let's say, for example, it's trading at the all-time highs. If the stock is already very extended, guys, I might trade in the money, because if we have some pullback here, I have a massive cushion here for the stock to drop, and I can still make money. But if I sell a covered call here, and if I buy the stock here, the stock drop a lot, despite the fact that I'm making money here on this covered call, on this call option that's going to be out of the money, I'm going to lose a lot here on the shares. But if something is trading all the way down here, I might sell a covered call, because I can make money here on double whammy, should I say, on a call option and on the price appreciation. So it's all depends as well where the stock is trading or the product that you might trade in. It can be an ETF, an index, or commodities. It doesn't matter. So in this case, you're pretty much almost halfway. It doesn't matter. We have room to go here to the all-time highs. A little bit more here to touch this low here. As you guys can see, we found plenty of value here. Maybe if IWM were to retrace, we retrace to this value here to see if the buyers can find value and push the price high again. But in this case here, I'll be quite happy to sell here in the money or out of the money covered call. Okay, but if something is trading, this thing here goes all the way up here to $280. I'm gonna do it in the money. I'm gonna capture less premium. I'm gonna have more downside protection. But again, it's very individually when it comes to your own personal goals and how much risk averse are you. By my case, that's the approach I take. I look at the chart, all-time highs, thank you very much, in the money. Some pullbacks I do like in out of the money, so I can make money on both ways, on the call option and the stock price, or I can still trade in the money as well to be more secure. But again, it's your choice. Anyway, guys, I hope you guys get the point. So thank you very much for all the beautiful support. If you have any question, leave your comments below. And if you want to support the channel so we can keep providing you guys free content, don't forget, subscribe to the channel, leave your comments below, and smash the like button. All the best, stay safe, and happy investing.